Welcome to the Cambridge Financial Podcast with Bert Salazar, CEO at Cambridge Financial Partners, LLC. This podcast is all about tax-preferred retirement planning, economics, financial risk management, and achieving a risk-free and successful financial life. Now, your host, Bert Salazar.
Good day, everyone. Welcome to another Cambridge podcast. I'm excited to be here with all of you today. Today's podcast is going to be a two-part podcast. And today's podcast is called Principles of Financial Economics. So because of the fact that this is such an important topic to deal with, I want to make certain that all of us get a feel for what we're trying to do from a financial standpoint, what we're trying to do in our firm, and how we communicate all the different areas of concerns and concerns that we have when we deal with clients in areas of financial education and financial planning. So today's economic podcast, I'll do part one today, and then next week I will do part two. My wife and I were going through this exercise a couple of nights ago. And one of the things that we share was the fact that I read close to 100 books every single year. Most of the time I have 2 or 3 books on a weekly basis that I'm reading at the same time. So whenever I get tired, I put one down and pick up the other one. But not only have I been an avid reader for many, many years, pretty much ever since I was in grammar school, I really enjoyed reading, writing, and so forth. But for the last 15 to 20 years, I have dedicated myself, although I've been in the financial services industry for the past 28 years, for the past 15 to 20 years, I have immersed myself in learning and educating myself as much as I can in reference to the principles of financial economics and that are so prevalent for the vast majority of the clients that I deal with, and for the vast majority of you that listen to my podcasts on a weekly basis, those of you that watch our webinars and attend our webinars and seminars, and obviously we do have a YouTube channel, and we also have a Vimeo channel that we use to promote education from a financial literacy standpoint. I am also a proud member of SOFA, which is the Society for Financial Education, which happens to be a 501c3 corporation that works with major companies and companies all throughout the United States, so we can bring about a change in illiteracy in the United States and bring it to literacy. So obviously these are things that I'm very comfortable with, things that I'm very proud of being able to participate, because as I always say, at the end of the day, information without education always leads to failure. So again, today will be about the principles of financial economics. And what I can say to you, and the reason why I pay so much attention to economics and writers of economic books and economists throughout the world and throughout times, is that methods are many and principles are few. Methods are always changing, yet principles never do. So the principles of financial economics never change. Now, methods have a tendency to change from time to time, and it can happen from one year to the next, or it can happen, from one decade to the next, depending on market conditions. But the basic principles of economics never change. And if at any point in time you as an individual trying to make investments or trying to prepare yourself and your family and your business for retirement, if you start to compromise and you start to jeopardize the principles of economics, then you're going to end up paying for it at some point in time in the future at a much, much bigger price. Now, one of the major principles of economics that we endure and we adhere to in our firm is that anytime that we engage clients from a retirement perspective, we're a firm that specializes in a risk management approach to retirement planning. In other words, if I can avoid my clients, if I can help them avoid the 4 major risks that are going to be affecting all of us in retirement. And these are some of the risks that we have talked about in the past. The risk of dying too soon, the risk of living too long, the risk of living with a disability, and then last but not least, the risk of living with eroding factors like taxes, inflation, stock market volatility, interest rate volatility, financial fees, lawsuits, propensity to consume, and so forth. If I can help each and every one of my clients, or if I can provide enough information to all of you in which you can do your planning by using a risk management approach, and that's what we do when we create our customized tax-preferred retirement blueprints for our clients, then you're going to be in a much, much better position than the vast majority of Americans that plan their financial life from a different perspective altogether. So what I'd like to do today, I'm going to go deeper into the first two major risks, which is the risk of dying too soon and then the risk of living too long. And then next week I will emphasize the risk of living with a disability and the risk of living with eroding factors, and what to do in order to protect yourself, your family, and your business from those actionable items that may hinder prosperity at some point in time in the future for yourself and your family. So let's get a little bit into the risk of dying too soon, and let's start digging in as to some of the things that you should be doing, that we all should be doing in order to protect ourselves from the risk of dying too soon. Now, one of the things that I always share with all my clients, because of the fact I've been in the financial services industry for almost 30 years, is that no one ever dies at the right time. I have had a number of clients that have passed in the last 30 years, and none of them died at the right time. Now, you may want to try to figure out what's the right time to die, and obviously all of us have a different approach to that, but there is a time in your life when you will know that it is the right time to die. And the challenge for that is that you have no control of that time. And because of the fact that you have no control of your time and when you're going to die, you have no idea what your status is going to be at that point in time and what your family situation is going to be. And most important, you're not going to know the type of liabilities that you may be facing at that point in time. So the best thing that we can do for those of us that do love our family and our business, and we care for what happens after we're no longer here, is how to make certain that we can mitigate those retirement risks or issues that are going to be very critical for us. So the first thing, and the one that I recommend to all of my clients, is to make certain that they secure enough term life insurance which should be equal to their economic replacement value. One of the challenges that we have in the industry is that the vast majority of Americans that own life insurance, they only figure out the amount of life insurance that they own from a scarcity perspective. In other words, they're always looking at their needs. They're not looking they're not looking at their replacement value as a human being. Now, every single human being has an economic value. And if you have a family, every member of that family unit has an economic value. And the job for those of us that specialize in retirement distribution planning is how to figure out what the economic value is to each and every member of that family. So when we do calculations to determine what is the economic value of a human life, we take a look at each individual in their own sense. How much money is that person earning? So I'll give you an example. Let's say you have a 45-year-old that wants to retire at the age of 65. He or she is making $100,000 a year, which is primarily the type of clients that we're dealing with. The vast majority of the clients that we engage are making north of $100,000 a year, some of them north of $1 million a year. But just for argument's sake, if we keep it to $100,000 a year, then if the person is 45 years of age and he or she wants to retire at the age of 65, then we're looking at 100,000 times 20. That would be $2 million right off the bat, which be the replacement value if that person were not to be alive for the next 20 years. On top of that, you have to add an opportunity cost. You have to be able to add future raises or increases in income or revenues, based if that person owns a business or happens to be, a professional, an attorney or CPA, or somebody who happens to be middle management or upper management. So we have to be able to take all of those issues into consideration in order to determine what the replacement value of that human life is at a given point in time. Now, all those rules apply to everything that we do. So, for instance, if you purchase $100,000 Mercedes-Benz, if you have a total accident or you have an accident and your vehicle is total, do you want the insurance company to pay you the replacement value for that Mercedes-Benz, or do you want the insurance company just to pay you what you need? Because you don't need to drive a Mercedes-Benz. You can get around in something a lot more inexpensive than a Mercedes-Benz. But all of us want a replacement value for all the physical assets that we own. So if your house burns down, you don't want the insurance company to pay you the value of a house or an apartment that you need. You want them to pay you the replacement value of that home that just burned down. So if you're using that strategy for your physical assets, why wouldn't you apply the same strategies to your economic replacement value, which is much, much greater than the needs-based value that your family may need in the future? Second point is that term insurance should be temporary in nature and should be converted as quickly as possible depending on financial circumstances. And the reason why I say that term life insurance should be temporary in nature is because you want to buy life insurance as much as you can, as early as you can, and you should do so as term life insurance policies, because you want to be able to protect insurability. But you also want to be able to convert those policies as soon as you possibly can to permanent contracts. And the reason for that is that almost 97.5% of all term insurance policies that are sold in the United States, the policies die before the clients do. So it's a profit center for insurance companies. Can you imagine if you owned an insurance company and that you only had to pay out 3.5 cents out of every dollar that you collect? How many days a week would you do that? Well, I would do it every single minute of every single day of every single year for the rest of my life. So that's what insurance companies do too. Well, when they insure you, you're making a bet. When you buy term insurance, you're making a bet. If you buy a 30-year level term insurance, you're betting the insurance company that you're going to more than likely die within those 30 years. The insurance company is making you a bet. They're betting you that you're going to live past that 30th year or the 20th year if you bought a 20-year level term insurance company. Term insurance policy. Guess who wins 97.5% of the time? The insurance company does. So you have to be very careful in making sure that you want to secure as much term insurance as you possibly can, but by the same token, you want to start the conversion process in order to maximize the internal rate of return on the things that we'll talk about in the next few minutes. Now, again, I already stated that term life insurance protects insurability. So that means that if you become uninsurable in the next several years, at least you have term insurance in place that can do that. By the same token, if you're going to purchase term life insurance, you need to purchase term life insurance that is convertible, meaning that at the point in time that you purchase a life insurance policy, you can then convert that product at some point in time in the future, either all of it or do partial conversions, and be able to do so without having to go through any type of insurability whatsoever. So even if you become uninsurable in the future, you had cancer, you had a stroke, or you had a major disability which now makes you uninsurable, if you buy convertible term life insurance, then the insurance company is obligated to convert that term insurance policy to a permanent contract or a 7702 plan without any evidence of insurability, and they would have to issue the same rating as you obtained before your disability became evident. So it's a great tool. Make certain that when you buy term life insurance that you also know that policy is totally convertible, and also find out what is the maximum number of convertible years that you can obtain. Now, you should also, and the next point is to start commencing the convertibility in pieces, to 7702 plans, in order to fill the tax preferred bucket and that we have talked about in the past. Remember that there are three major tax buckets that we deal with throughout our lifetime in the United States. You have the taxable bucket, you have the tax deferred bucket, and then you have the tax-free bucket. There are only 4 products available in the tax-free bucket, and the tax-free bucket are the municipal bond funds, the Roth IRAs, the Roth 401ks, and then last but not least, a 7702 plan. So you have to make certain that you can maximize your contributions to the tax-free bucket as much as you possibly can. Now, I always suggest to my clients to diversify their 7702 plans. They should have whole life insurance. They should also have index universal life insurance. And they may also have universal life products in order to fulfill the preferred tax bracket or the tax-free bucket in order to maximize the internal rate of return on these products from a straddling or a combination standpoint. Now, you also want to provide maximum efficient contributions to 7702 plans. And when I say maximum, I mean max out. M-A-X. And you also want these products to contain long-term care riders, because long-term care rider is one of those major risks, the risk of living with a disability that many of us are going to have to deal with in the future. Now, you notice I didn't use the word match. See, match is when you put money into a qualified plan or a 401k in which your employer is giving you a match, and we'll talk about that in the next few minutes. Here, what I'm trying to educate you on and provide information on is you want to have a maximum efficient contribution to 7702 plans that you can use for a number of different things. You can use it for estate planning purposes. You can use it for legacy planning purposes. You can use these plans as Social Security replacement. You can use these plans as asset replacement, and we'll get into some of those conversations at some point in time in the future as well. You can use them for family protection. You can use them as a supplemental retirement plan, as you will see in the next few minutes. You can also use it as a way to protect your assets, and you can use it as a way to spend down your assets and create guaranteed income that you and your family cannot outlive. You see, 7702 plans under the IRS tax code is the only vehicle that fits into the 4 major risks that most of us are going to have to deal with. You can apply 7702 plans to the risk of dying too soon, to the risk of living too long, to the risk of living with a disability, and to the risk of living with eroding factors. There's no other product that is sold in the United States and throughout the world under the IRS code that will allow you to be able to efficiently protect yourself from the 4 major risks, and there's not a single product that can come close to doing that other than a well-structured 7702 plan. Now let's get into the risk of living with a disability. Again, the risk of dying too soon, I can spend all day just discussing all the different strategies and techniques and straddles that we can use, but at the end of the day, I want to make certain that we maximize the time that we have available. So the risk of living too long is totally the opposite of dying too soon. And the reason for that is what used to kill us, 30, 40 years ago is no longer killing us. So that means that people are going to live a lot longer. Now, back in 1935, when FDR came up with Social Security, most Americans were not going to reach Social Security retirement age, which used to be 65 at that point in time. And if you did, chances were that you were only going to be collecting on Social Security benefits from anywhere from 2 to 5 years. Well, today, you can actually spend 3 decades in retirement. As a matter of fact, the vast majority of the planning that we do for our clients, we take into consideration 30 years of retirement and 30 years of retirement assets and 3 decades of retirement as well. So the first thing that I do recommend to the vast majority of my clients, and also to people that I passionately educate on a regular basis, is to start a savings program as early as possible. There's no such a thing as being too young to start a savings program. Most important, a percentage of the savings should go to your taxable bucket, and those are the CDs and mutual funds, savings accounts, etc. By the same token, we have to be very, very, very careful with how much money we put in the taxable bucket, because remember, every year you will be receiving a 1099 and taxes are going to be due again on those investments. I don't know if I've said this enough times, but the vast majority of clients that we engage, and we also do tax preparation and tax planning in our firm, the vast majority of the clients that we engage are paying way too much money in taxes. And many times they don't even know that they're paying so much more money in taxes that they need to from a business perspective. Obviously, there's a difference between tax avoidance and tax evasion. So we want to make certain that we can bring our clients to the very max of tax avoidance without violating any of the IRS rules that would now bring them into a tax evasion situation. Normally we don't want any more than 6 months of fixed expenses in the taxable bucket. Now, some clients may want to keep a little bit more if they're investors or they're looking for investment opportunities. But 6 months is a good rule of thumb. So if you have expenses of, let's say, $5,000 a month, you should not keep more than $30,000 in your taxable bucket at any given point in time. Now, a percentage of savings should also go into your tax-deferred bucket. Now, tax-deferred bucket, as you all know, is the bucket where the IRAs and the 401ks and the pensions and the SEPs and the deferred compensation programs go into place, the 403bs, where the money goes in pre-tax, the money grows tax-deferred, and then when you pull the money out, you have to pay taxes on the whole thing. Here, a recommendation is if you're participating in a qualified plan at work, if you happen to be an employee and you're participating in their 401k or whatever plan they have in place, make sure that you do a dollar-for-dollar contribution up to the match, and never, ever to exceed 7% of your income. And the reason for that is that most Americans want to max out their contributions to their 401k and IRAs because they feel that they're saving on taxes. Whenever you put money in the tax deferred bucket, you're not saving anything. You're not saving on taxes. You're postponing taxes. And when you postpone tax, you also postpone the tax liability. And the big question to all of us, and this is the one thing that we talk about in every single conversation that we have with you over seminars or webinars or podcasts or one-on-one video conferences, is that there's a very high probability that taxes in the future are going to be a lot higher than they are today. So why would you want to defer taxes so you can pay them at a much higher level in the future? Now, the rest of the savings, once you fund your taxable bucket to the right level and your tax deferred bucket to the right level as well, the rest of the revenues that you're generating should definitely, all of it, should be placed into the tax-free bucket. And here you have your Roth IRAs, your Roth 401ks, and your 7702 plans. Notice that although municipal bond funds are part of the tax-free bucket, I didn't mention it in this example. And the reason for that is that although the income generated from municipal bond funds is free from federal income taxes, they do have a negative impact on your Social Security benefits and your Medicare premiums in retirement. So to me, it's not totally exempt. There are only 3 vehicles under the IRS code that are totally exempt from any type of tax, and those are the Roth IRAs, the Roth 401ks, and the 7702 plan. Now, another thing that I do recommend in order to protect against the risk of living too long is to participate and or create a guaranteed stream of incomes for retirement purposes. And by the way, I deal with a lot of retirees, and the one thing that most of my retirees tell me often is that they wish they had more guaranteed income. Because if you have guaranteed income that you and your family cannot outlive, your retirement distribution planning will be totally different. Your life is going to be a lot more comfortable. You're going to have less worries, or you can, start to dedicate more time to doing other things that are so much more critically important to you and your family, as opposed to have to count pennies because you want to make certain that you have enough income at the end of the month. See, I don't measure wealth by the amount of assets that any of my clients own. I measure wealth by the amount of cash flow and guaranteed income that they can generate out of those assets in retirement on an ongoing basis. So that's very, very critical for all of you to understand. Now, if you happen to not be on the top 1% of people in this country that have a guaranteed pension because they either work for a large corporation that provides a pension to their employees, or they happen to be a governmental employee, you do have the ability to create your own guarantee look-alike pensions or look-alike Social Security benefits because you do have the ability to create guaranteed stream of incomes you and your family cannot outlive. So those are things that are very critical. Now, how do you do that? And that's a question that I normally get. Well, Bert, if I have all of these assets in place, how do I create guaranteed income for life? Well, you can create it in a number of things. Number one, you can purchase or take a percentage of your assets and purchase immediate annuities. So you can purchase index annuities in which you would have an income benefit. Now, sometimes, I look at those very closely because it's important to be able to understand how they work. And you can also create guaranteed income through fixed annuities. So annuities in the United States are very critical for most retirees. By the way, prior to 1980, and that was pretty much the beginning of the 401k world as we know it today, the vast majority of Americans in the 70s, 60s, 50s, 40s, and 30s, the vast majority of the assets that they put away for retirement and that they had in retirement were primarily in 2 vehicles. They were in savings bonds, and they were in 7702 plans, whole life insurance policies. And they had been making contributions to those plans for many, many years, so they had substantial assets inside of those products in order to make certain that they were able to mitigate the retirement issues and concerns that Americans were facing at that point in time. Now, in order to reduce the risk of living too long, besides creating your own look-alike pensions and Social Security benefits through fixed, immediate, and index annuities, I highly recommend to my clients many a times. Now, obviously, every client is different and their way of thinking may be different, is also for them to create additional guaranteed income through real estate property acquisition programs, meaning, buying real estate, rental real estate. Or real estate for investment purposes. You can buy apartment buildings, and they don't have to be that expensive. You can start buying, anywhere from 8 to 12 units apartment rental in which you can start to receive income on an ongoing basis. Now, some of my clients have asked me if it's okay to use qualified plans to invest in real estate assets, you do have the ability. Obviously, the IRS rules allow for self-directed IRAs, which, those IRAs can be used in order to invest and buy properties, real estate properties, and have real estate acquisition programs as well. I don't recommend it because of the fact that if you're using qualified plan money, meaning IRAs or 401ks, so you transfer to an IRA in order to buy property, then you're actually losing some of the major reasons why you want to buy real estate to begin with. And obviously there are many reasons that you can use, and I've done some podcast on how to measure the internal rate of return on real estate acquisition, but the two major ones that you lose is depreciation and capital gains. See, any gains that you have inside a qualified plan will be taxed at ordinary income. And because it is inside a qualified plan, you can not really take the benefit of depreciation in your real estate property. So you're actually giving up a tremendous opportunity that you could have if instead of using qualified plan money, you use non-qualified or tax-free money from a business perspective. So again, when you're dealing with protecting yourself and techniques and ideas and straddles that you can use in order to mitigate the risk of dying too soon and the risk of living too long, it is critical to understand that one size does not fit all. Every individual is different. You can actually create, by using 7702 plans, you can create an incredible retirement plan for you and your family, which most Americans have not really done their due diligence in and do not understand, and they're missing the boat, as we normally say, in many different ways. From that perspective, education is very critical, because the more educated you are and the more contrarian you are to the rest of the world, the better off you're going to be able to live in your financial life. So I just wanted to take today a few minutes to make certain that I share some of these principles that I continue to make sure that we all have a clear understanding of, and these are principles of financial economics that I share with each and every one of my clients as we engage in a retirement distribution planning. As always, I want to leave you with my number one thought for all of you, and that is that my goal and that of my firm is to kind of help you change the way that you see things, because when you change the way that you see things, the things that you see change. So again, thanks very much for giving me a few minutes of your time today. I look forward to seeing you next week, in which we're going to be covering part 2 of the principles of financial economics, which will now go into more details on the risk of living with a disability and the risk of eroding factors, and what are some of the things that you can do for yourself, your family, and your business in order to protect and mitigate that risk. See you soon.